Hey, what's going on? This is Jeremy back with another video, J Leo, for some trading and currency, cryptocurrency, uh, indices, what have you. So, this weekend, I'd actually looked at a couple of markets, this being one, uh, Sol and Tether. I think it's Solana. Solana is the market Solana, and then USD or Tether USD. On the 5 minute, just looking at a couple of different options here. I know you could say, well, why do you have two areas? Just really quickly, I'm looking at this is basically the area in which the short was initially created. This low was taken out here. So the overall range, protected high range, is probably going to be up here. This is going to be the liquidity, and I could just draw my little money sign down here. So that's basically me saying that's going to be the liquidity low. I'd be looking for this low to get taken out. Just something in terms of how I look at markets, and then I don't have a problem explaining this. It's not, again, disclaimer, not financial advice. Don't sue me. Any decisions that you make to take positions, trade markets, whatever. This is all educational, and then also just entertainment purposes. We'll leave it at that. It's just my own personal analysis, certain things that I look at and see. So really quickly, it just depends on what your perception and what your overall view of the markets are. As I initially said, I looked at this initial move, this initial push that created this low here as one range. So we have basically a market break. You're looking for this basically to be potentially a catalyst or a trigger for maybe the market to come back up, retest this area of this last buy before the sell, and then drop back off. But what instead happened is we did get some level of retracement, and then I'll just use my cursor here. And if you follow this all the way across, right, it never came to tap back into this last area where there was a significant buy before this sell off, right? So this didn't happen here. But I'm going to share an idea with you for educational purposes. Don't sue me. And again, it's just a thought, and it's one of the things that I look at sometimes. Again, this retracement did not clear this last zone, this last buy to sell. But what did end up happening is there was a certain amount of a lack of participation here. Sometimes you'll hear when you see a an extremely motive move like this, where somebody will say, "Well, there's a lot of IDP or inefficient delivery of price." It just means that all the participants that could have taken a position or could have participated in this move were not able. So a lot of times that's why you'll see a correction occur in certain areas. Now, again, one thing to stress, and a reason why a lot of YouTubers and people that talk about markets have to say, hey, disclaimers, educational, whatever you do is you, because there are that whatever percentage of people out there that say, oh, well, such and such told me that price was going to retrace in here and then it was going to do this, and then I listened to them and they didn't know what they were talking about and they were wrong. Well, I preface my remarks in saying that by saying this. Not in every situation that you see a market move is a market going to automatically come up, provide a correction to then continue, or to continue in that given direction, or to reverse completely. Okay, so whenever you see any level of inefficient delivery of price, don't automatically assume that an immediate correction is coming. Okay, let me say that first and foremost, because again, I am operating off a 5 minute time frame. These types of things do happen from time to time. Sometimes more often than not, just depends on the market. You just kind of have to go out there, do your own research, pick a market, watch it, follow it, study it, take notes, take screenshots, take more notes, continue to watch and screenshots, and then over a period of time, you'll develop you'll develop an idea or concept in terms of how certain markets move, where they may not mitigate, and then also you're looking at the time that may either be a constraint or an allowance in terms of how price like this sometimes will eventually get mitigated for, again, a continuation or a complete reversal. Okay, so that being said, again, last buy before this sell, this extreme motive, and then you see the corrective come in here. Okay, it put this lower high in place that had not come back to tap into any of this buy before this sell. And then we see where it basically it's off to the races again. This leads to a continuation, which then this takes out this low. And for those of you that can't exactly see that, I will just do this. And we'll put that in black, and then we'll make that black. Oop, sorry. We'll make that black. We'll just make it a 3, so that way you can see the clear distinction between the original low for this initial push short, a retracement or a correction back into a area before it then dropped off, and then it clears. So here's the new low. Now here's what I wanted to bring to your attention. And two things can be right at the same time, which is why you have, and I have, not you, but why I have two zones drawn out here. Both of these scenarios can be right at the same time, or neither of them can be right at the same time. And here's what I mean by that. I have this original area marked off as basically a specific area that I would look for potential shorts to take place from. However, there's an intermediary structure that's developed because of this retraceable lower high that ran this low. So now I'm actually looking at this area because I'm going to move my area over here a little bit so you can see this candle and this wick. And there's a reason behind why I'm actually looking at this area now as well. So we said that this was a lower high that was created, did not tap this original area. Well, if I pull this all the way across, I want you to see something. And I'm going to pull it beyond so you can actually see these wicks. So now you see the lower portion of this entire zone. And you also coming back across, if you just follow my cursor all the way back across, I'm kind of going in a circle here. This wick basically clears the open of this overall move here, right? Does everybody see that? This wick taps into this original supply zone. For those of you that are supply and demand, you could look at this as a supply zone. Okay, so it taps the open, it mitigates the open, and then it continues short. Okay, so with that context in place, I'm now in a position where I can do one of two things. And I've done both of these from an RR perspective. I know you see what my risk to reward is over here. Again, I always like to point out, see this thing here? This says paper trading. So I always like to practice what I preach, which is to tell a lot of people, sometimes it's good for you just to go in to get a feel, to understand even your edge, even if you know that you have a significant edge in the market in terms of what you look for, your rules base that have to be met before you take a position, your risk management in place before you take that position. It's always good just to kind of continue to refine and refresh. Practice. Repetition is like anything else, right? So all that said, I looked at two potentials here, and because I'm in a paper trade, this isn't, either one of these is not going to make me or break me. Getting in here would technically be getting in early if price does continue long back into this area, back into this supply, which was more of a direct supply area I was looking for. Yeah, am I in a more significant amount of drawdown? Yes, but again, based on the risk, maybe not. It all depends. However, if we were just looking here specifically, this is about 30 pips. This, if it delivers within this specific zone, if it taps me in here, the reward is 123. So this is basically just looking at it on the surface. It's exactly what it references here. Sometimes I don't go by this risk reward. I like to look at what my risk is in terms of pips, what or I look percentage, but when I look at it in terms of pips, it's going to tell me what the ratio is. It'll tell me essentially what the percentage is based on what I'm putting on the table, right? So this is basically a 4-to-1. So if you're risking 1%, you'd be risking 1% with the potential to make 4 if it delivers, and then vice versa. If you lose it, you're losing 1%. Obviously, if you're risking less than that, which is what I do per trade, just me personally, I'm never really going to be at a 1% loss. So again, I would be looking for price maybe to tap back in here, because the way I'm looking at this overall structure is I'm looking at, okay, this is my original supply, price pushed away, created this low, came back up, created a higher low that did not tap in, right? Then it ran this low. Okay. So ideally, you would be in a range from here to this new low. But looking at it from a contextual standpoint and a bias standpoint, this isn't really the zone I'm in. This isn't really the range I'm in. I'm still in this range. So it went from here. Now it is just simply here to here. And the reason why I'm making that distinction and sharing it with you, just again, something that you can incorporate or not. You could take what I'm saying as BS and say, I don't know what the hell I'm talking about, and that's totally fine. But the reasoning behind why I'm saying the range is no longer from this potential protected high to this now new low, and it is now from this protected high to this new low, is because there was not a mitigation of this original supply. There wasn't a mitigation of this last buy to sell that would let me know that, hey, when whomever, whatever operators, composite or otherwise, big money, when they came back up, they made this corrective move back up and in. They did not close any of the orders that they initially put into sell to buy in this area. Okay, basically saying this zone is still active. It's still, there's still a potential. There's a potential. Okay. Just keep it in mind, and then I'm gonna move this out of the way again, and I'll explain it further. But didn't come back in, didn't tap this. This is still active. It's still a potential, right? Came back, mitigated a lot of fair value gap, inefficient delivery price, whatever you want to call it, whatever your terminology is. A lot of that would have been correctable, allowing participation in here. And then once whatever occurred, composite, big money, otherwise, they said, okay, we're done collecting, we're done transferring, we're going to run short again. And now we've collected and accumulated enough liquidity. We've done enough of the transfer, weak to strong, weak to strong, weak to strong, or excuse me, weak to strong, weak to strong, weak to strong, weak, strong. So we're going to run this low now. And when we put this low in, we're going to come all the way back up, and we're going to liquidate this high, this original retracement from this motive move. We're going to liquidate this. And now, because we're liquidating that, guess what we're now doing? We're going to tap this open. We'll tap the area where we last instituted a strong move in before a weak to strong, another weak to weak in here, strong, weak, strong, another weak, strong, weak, strong, weak, strong, in terms of a transfer out of the market, right? You're transferring from a weak to a strong hand. The weak bullish, the strong bearish, right? This intermediary didn't tap. You came here. You actually liquidated this high. You've now tapped into this larger supply. So with that, there are two instances now, okay? There's been a liquidation here. So a lot of times you could say, okay, well, the liquidation may mean there could very well be the creation of a more deeper push in that given direction short. That's one possibility. The way I look at markets, I would say, okay, well, you tap the open, right? Mitigated the open, and that could very well run. But because you've absorbed here, this is still the liquidity low, in my opinion. Okay, and as you can see what price is doing, because, and this is one of the reasons why I like doing crypto over the weekend, you can see the market is pushing lower. Now, I haven't gotten a tap in at all. I'm not going to cancel this at any point. The only way I cancel this order is if this price now, as price is moving, if it breaks this low. And then at that point, what I may very well do is cancel this top zone because, again, what the market is telling me is same thing I said to you a few minutes ago. While there's still potential orders in this area that can be closed and transferred out as weak to strong to continue short, it is not any immediate bias of how price is moving. It would probably be a little bit more centered on this absorption or this liquidity of this intermediary lower high to continue lower. And it may very well be this area if price delivers lower, comes back up, taps here, and runs short. Unless there's a deeper liquidity need and price is going to run much lower than what is originally anticipated in this range. But again, the point that I was just trying to bring your attention to and to show you is that you can have a specific bias, and then my bias, obviously, in this case, is short. And within a short bias, you could actually have two areas in which you're looking for certain things to happen. And both things can be correct at both times. Just one moment, please. Hi, of course, it's Jeremy. Hi. Okay. How many hours you get? Okay. All right, I'll get you paid. Thanks, Jeremiah. Okay. No problem. Have a good day. I'll see you. Okay, sorry about that. Had to take a phone call. So in those instances, as I said, you can have two things that actually can bear out to be true. Both can be true, and conversely, both could be incorrect because we could actually see a situation where price moves, it breaks this low. We target this area and say, okay, this was the last quote unquote intermediary supply that was mitigated and it mitigated the open. So because it's mitigated the open, this zone is invalid up here. So we're only looking at this. It could create this new low. Price could come all the way back up. It could liquidate this whole zone. It could tap in here, look like it's going to deliver short and liquidate this as well and continue higher. So that's one of the reasons, and that's one of the things when I say, both things can be right, and at the same time, same thing. Now I think I'm Jamaican. The same thing, man. Um, both things can be right, but ultimately, yeah, both things can be wrong as well. So again, just for conversation and context purposes, again, at this moment, even though price is mitigating, I'm looking at this as it's basically creating interterm liquidity to either push back into this area, mitigate a little bit more, and run short, or potentially come back up, mitigate some more, drop back off, and maybe push into this last area before running short. I typically like to look at certain things in a given way within my trading edge or my trading strategy, which for some reasons and I would say for obvious reasons I don't share because I don't ever want what I do or how I trade to be a thing where there's ever a worry about whether or not there's a course or any of that coming, because I was pretty adamant about something that I'd said a few videos or so ago, and I absolutely 100% meant it. This channel is never going to be one of those situations where we go into any type of technical analysis or outlooks where there's going to be an underlier where I'm going to be suggesting that I want you to come join my group or a mentorship or sell a course or any of that. I think that for the few, I would say for my mentor specifically, it was a wonderful thing for me. I personally have my own view and concept of what happens in specific markets, what you could or could not look for. And like I said, they work for me, but I would at no time really want to impact somebody's overall thought process of how they view or how they take positions and alter maybe their trading plan unless they just don't have a clue. And if you don't have a clue, I would just simply tell you, drop a comment in the comment section below, or you can email or reach out to me and say, hey, listen, I'm clueless. I'm looking for some direction. And rather than me tell you, hey, yeah, glad you reached out. Here's my course. I'm not going to give you my course. I'll give you my mentor's information. And then I would have to basically get his permission at some point, maybe in a future video, after talking with and talking to him. If he gives me the permission, I'll put his information or contact information in the description box as well. And that way, if you have any question, you're looking for direction, you don't have a trading plan, don't have any risk management, don't have the psychology, etc., etc., there is someone that I can definitely tell you 100% that I could put you in touch. You could experience and see if what the information that's being provided you feel is worth it to you, because at the end of the day, this is an industry, this is a lifestyle that no matter what someone gives you, it's still 100% on you. So you could be put in. It's kind of like, and this is not a thing, I just thought about it, so I'll just say it. I would liken it to something like a Warren Buffett effect. And a Warren Buffett effect, and me just pulling something out of my ass, is to say, if tomorrow, Monday, March the 6th, you woke up and there was a knock at the door, your doorbell rang, and you went to the door and it was Warren Buffett, and he said, "Hey, listen, we're gonna hang out for the next 30 days, or you're gonna come with me, and you know you'll be with me for 30 days." And he's not telling you you're going to be with him for 30 days because he's going to show you the ins and the outs. But even if he did and said, hey, you're just going to follow me and you're going to, pick up some notes, guess what happens? At the end of 30 days, you could have been with Warren Buffett. You could have followed Warren Buffett. You could have eaten what he eats, drink what he's been drinking, learn some new dynamic in financials. He could even show you exactly what he does. But after those 30 days, there's something that's going to have to happen. Even if you've been asking questions and taking notes within the 30 days that you're being buffeted. You're being buffered. But yeah, I'm kind of corny with my humor. But my point is, if you've done everything that you could do in those 30 days, after the 30 days, you know what you still have to do? You have to translate all of that information, all the level understanding that you think you have, into practical application, and you still have to make it work for yourself. And if at the end of whatever that time frame is, because everyone wants instant gratification, they don't want to take the time that it would allow for you to nurture certain understandings, certain ideologies, certain biases, to extrapolate that information into a successful plan. If you get away from instant gratification, maybe at some point you'll have an aha moment. If you're looking for the instant gratification based on what you've observed, asked, and been predisposed to for the 30 days while you being buffered, I can't get away from that. I'm sorry. Even if you do those things, you might very well turn around and say, well, this shit doesn't work. And are you going to tell one of the richest men in the world, man, you don't know shit? Apparently he would, and he does, if he's one of the richest human beings, right? So if you understand and you take full context in what I just said, even if somebody puts you on the road to be successful, it's still up to you to basically put all of those tools and resources to the test and exhaust every learnable possibility until you come up with not necessarily the modes, the methods, and the exact process that someone's laid out for you, but to take that methodology and that information into something that is digestible and that you can replicate time after time after time again, which would then allow you to remove any emotional barriers that you may or may not have within those specific areas. So when it comes to trading and any level of finance, yeah, there are emotions involved. But the more systematic of an approach you take towards it, there's something interesting that happens. It's then about just the process and the execution, and there's very little emotional stimulus that's involved because, again, you're following a set rule plan, and there's a practice of simple question and answer. Does this does this fit, and does this meet my criteria? Yes. Okay. Are my rules being met? Yes. Okay, does that seem like that's a good risk reward? Yes. Does that seem like that's a good risk reward? Yes. Okay. Check, 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 check. Okay. Place the order. Go on about your business. Now you're done. And if, as I said, it's a double-edged sword. Price comes up, in this instance with this market, price comes up, taps me in. Okay. Price comes down, mitigates, runs. If my stop was here, stops me out, okay, no problem. Just delete the zone and go on about my business because I realize, okay, there may be a deeper mitigation up here. Price comes up, taps in. Okay, great. Go about my business. Come back. Price comes down, price comes up, stops me out. Great. Okay. Was wrong. Go back and look what happened. It could be this area back here. I might look at and go, oh, okay, well, hey, let's see. That came up, didn't tap. Now, does that mean I'm going to immediately stop if this liquidates me and go, oh, yeah, it should have been this last buy to sell here? And no, I'm not going to do that. I'm going to wait and see, okay, well, where could I have gone wrong? I'll look, and then maybe I'll come back and revisit after giving the market enough time to show me what is the overall bias. My overall bias, even zooming out, looking at this, is, again, could I be wrong from here? Absolutely. Could I be wrong from here? Absolutely. But guess what's not going to change based on what you see on the screen and what I'm looking at right here? My overall bias of this market being short, not going to change until I'm stopped out a couple times, and then I just stop because now I want to see if the market maybe is doing something else other than what my bias is showing me, what my rule base is showing me, what my technical analysis is showing me. So if those things change, then I just stop. I'm not forcing anything. I'm not getting emotional, which is forcing. I'm not getting upset because I got stopped out because, hey, I'd much rather lose a lot more than I win because I realize if the bias is correct and I lose a few times, you know, these two losses, and that's what some people don't get. And I'm just going to say this real quick. Don't want the video to get too long. But that's one of the things where when you're hell set and hell bent on getting into a position or a trade, if you lose this one, you jump right back in. You lose this one, you jump right back in. You reevaluate, go, oh, it's short from here. You jump back in, you lose here. You jump back in, you lose here. After 4 or 5, depending on your risk tolerance, you may be completely out of the market. And there's a weird thing that happens in trading. I sometimes I think it's hysterical. It's happened to me, but you'll continue to see moves that will take you out, right? And then I'm gonna draw this one back here because this will be in here. And then that one, this move takes out this high, right? And we'll do one more. The next move takes this one out. You still have this one up here. So let's say you go 1, 2, 3, 4. So it takes you out after 4, right? Now maybe you're out completely. This is one more, and then price. Wait, let me do it this way so it'll make sense where you could actually see. We'll just draw. I'll just draw this box here, right? We'll just draw this one here, and then I'll slide this over to where, yeah, it takes out that high, and then we'll just say this one takes that one out, right? Still within the confines of this area, but let's say for whatever reason, you're looking at this area here, right? and say that's the last. This is the last one, right? You're looking at this move up, saying, "Oh, okay, it moved up. This was a lower high here, and then it broke down. Okay, surely it's going to stop here. Well, it liquidates you here, but you still got this high, and then you've done that 4 times. Price comes up, comes here, right? And then the next thing that happens from here, it falls off a cliff. It happens. It's I can't even tell you how many times it's happened to me, but again, you could look at the overall, and this is maybe not the best chart art. Maybe it's not the best chart art to look at, but there is something that can be taken from this. Okay, and this is one of the things I'll say. I'll go through this shortly, and then I'm gonna wrap up here. But there is something that you can actually take out of this. Okay, the thing to take out of it is risk management. So this would be 1, 2, 3, 4. We'll chalk this up and we'll just say that these are 4 losses. Okay, those all of the arrows are representative of 4 losses here, and I think I said this was 30. Yeah, so that's 30 pips. So we'll say this is 4 losses at 30 pips each. And I know we deal in percentage, but just again, just to keep it as simplistic as possible. Okay. So we'll count them 1, 2, 3, 4. So all 4 of these are 4 losses at 30 pips, right? So you've lost 120 pips if you're into counting pips. You've lost the total of what this trade would have yielded for you if you'd won it, because this was a 4 to 1.1, or excuse me, a 4.1 to 1, right? 123 pips, risking 30, but you just lost 4 trades in a row. You've lost what this reward would have been in 4 trades. Then this 5th trade pops up, and let's say this is one that you didn't take because you've either been stopped out, your account's been liquidated, whatever. Okay, and we're just gonna assume that it runs this low. This is 306 pips. I don't know that you can see that. I think you can, but this is a 19.12 to 1. So you'd be risking 16, and this is key just in terms of something that you should always keep in the back of your mind. Okay? And why risk management is so important. This is one of the reasons why. I'm gonna pull up a calculator, and we're gonna and you don't have to guess. 306 and 120. You don't have to guess because I'm gonna do it for you. So that's 186. So I'm just gonna draw one more out here, and wait, hang on for me. Hang on, hang on, hang on. I just want to put it underneath the bottom here. So you'd be plus RR and 186 pips if you're counting pips. And I know you could say, well, how the hell am I going to be a plus RR? Well, again, risk to reward. If your risk is manageable, which I know you're going to be like, well, it's risk management, so wouldn't it be manageable? Some people are not. Some people will take this 4 to 1, they'll lose this trade. They'll come up here and they'll go, well, I know this is going to be a 6.5 if I'm still looking at the same zone. So I lost 1%, so I'm going to risk 2% here. Okay, that fails. Now you're down 3%. You come up here and go, okay, well, I'm down 3, so let me risk 3 to make back the 3 that I lost. And now if this is a 6, we'll just say this is probably like a 9 or 10, right? Do you understand where I'm going? So if you're managing your risk, And that's why I just said 30. We just deal with 30 pips instead of percentage. But ultimately, if you're at 1%, there's a good chance, depending upon if you're working through a prop firm, you're going to be close to your account being closed. If you know you're at 5%, because I know I said 4 losses at 4%. It depends on if you got another position open. I won't go into all of that, but we'll just say it could be negligible if you're managing your risk. So if you're down 120 pips and then you say, "Fuck it, we're gonna try this last one. My stop is 16 pips, and we'll see what happens," and this delivers. Well, guess what you just did in one trade? You lost 4 in a row. You won 1. You're gonna be plus in your RR because that's what, 19. And if we just assume, since this is a 4-to-1, let's just assume that these 4 trades that you lost, okay, we're going to be within the same ratio of 4-to-1. I know this was 6, but this was my original. But we'll just assume 4 times 4 is 16. This is 19. Your plus RR is going to be on or about 3 RR, okay? And you're still going to be plus in pips. So the thing to take away is, even if you see somebody with a low strike rate, low win percentage, or every time you see a trade, you're like, damn, they're always losing a trade. Always remember, if you're trading with an edge, if you're trading with a set bias, if you're trading with set rules, sometimes it doesn't matter how many losses you take in a row if your risk management is intact. The risk management is just like that's another part of your trading plan. They're not mutually exclusive. They are one and the same. So if you're following your plan, you're following your rules, losses happen more often than not. And if you're following a solid risk management plan, this kind of a concept and idea, you'll understand. You could literally be in a hole, 16 RR in relationship to moves and 120 pips or 4% down, to then turn around and be able to, manage 3 to 4% return and 186 pips in positive growth for the account, or whatever situation, whatever your tolerance is. All right. So hope this helps somebody. I will be back probably Wednesday or Thursday with another video. Next weekend, I'm actually going to turn on the camera, and then I think what we'll do is just kind of hang out on a Saturday afternoon, do some live crypto trading. I'll be doing it out of my paper trade account, so should be fun. Take a picture of this because yeah, it's all about to go the way of the dodo. Here, can't get it to go away. It won't go. It won't leave. So we'll make it leave. But anyway, everybody have a good day. I'll see you next time. Take care.